Look at copper, the momentum, that's a distance. It's not stretched anymore, copper. Look at that. It's totally reset, right? Totally went sideways, a beautiful consolidation because it didn't consolidate too hard in price. It consolidated in time and price. Look, the both moving averages are coiled and tight, 12-month, 36-month. These are very, very rare opportunities.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we have Karim of NorthStar BadCharts. Patrick is a seasoned technical analyst with a sharp eye for macro trends and chart patterns. Patrick decodes long-term trends across commodities and equities, helping investors see what others miss and navigate the markets with a strong contrarian edge. We are going to pick his brain and ask the questions you submitted. Patrick, thank you for coming back on the show.
Hello, Steve. It's always a pleasure. I can't wait.
Pleasure is all on this side of the table, sir. I'm going to start out like I always do with all my guests. What is your macro view of the world economy and financial markets today?
Goodness. All right. Well, there's a whole bunch of macro economic metrics that aren't looking so great, like unemployment rate starting to creep up, U.S. initial jobless claims hogging a breakout line that I have around 247, 250,000. But they haven't broken down yet. But historically, whenever we've seen rock bottom unemployment rate starting to trend upwards, when we've seen the 10-year minus a 2-year rock bottom starting to trend upwards, it's environment where you're set up to possibly have a recession. So yes, a recession in itself, it's not really a tradable thing, right? Oh, I'm a recession. But then if you put on your mind, you're fearful, and then you're just not going to play anything. But what happens is often you could have silver flaring up into a recession. You could have the miners flaring up into a recession. And then just once the crescendo of the recession, like the middle of it, where really it gets bad, then after that, you get these crazy moves down, these huge corrections, like we had the GFC 2008. Because if you remember, the GFC 2008 recession actually started, they backfilled it. I think that started in 2007, right? And they backfilled at the end, maybe in 2009. But in 2010, they backfilled the end. By that time, everything had recovered. Everything was rocking upward. So if you're living in the fear or always waiting for the government to tell you, or the National Bureau of Labor and Statistics, whoever does this officially, you're not really gonna, you're gonna live in the fear, right? The markets are a lot forward looking, and they could what's that word there? Help me, Steve. Exacerbate upwards into a recession, and people won't understand what's happening. They think the recession's off, but then there's like a vomit in the price action, and then after that, when everybody thinks it's the end of the world, and that's when everything starts rocketing upwards. So while that setup is there is an important chart I could show you after I do this, that the miners, they could sniff out this macro. Could I share the chart now?
Yeah, let's do it. Yeah.
Go right into it, because this chart's kind of important there. I'll show you guys. Name me. Okay, let's do unemployment rate or initial claims. Okay, let's do initial claims.
Okay.
Initial or unemployment. Let's do unemployment rate. Let's go. So here I have unemployment rate for the states. I'm going to remove all indicators, keep it clean. So here I have unemployment rate, guys, since 1948. And then I'm going to overlay the recession indicator. So all these green overlays, guys, these are the recessions. I'm going to put here like this. All this recession. And you'll notice that every single time that unemployment rate is low and doing a higher low, starting to crescendo up.
Yeah.
Recession. And look at that. Look at it's once again there. It's not. I have a breakout line here at 4.2. So if ever the unemployment rate could get back above 4.2, now I think it went down actually to 4.1. If ever it could get back above 4.2, and this vomit there, it's possibly. But I'll show you what's really, really eerie there. And this next chart I'm going to overlay, guys, should make you really, really think about what's driving this whole show there, this whole macro show. Often we have, I'm buying this gold or silver company because I love the management, the supply of gold. They have X amount of supply in the ground, like whatever your supply and demand or fundamentals or management, whatever you like about the company, earnings per share, all that stuff. But I'm going to overlay the gold and silver miner chart. This is as a guide, the gold and silver precious metals fund, which is miners, but it dates back to before 1970. And it's the same thing as JDX or the Huey, guys. I could overlay, I do a correlation returns adjusted indicator, and it's practically the JDX, guys. So you just use the ASA because you're going to get data going back to before when the JDX started, like in the early 2000s there.
Yeah, we don't have as much data with the GDX, but this
Now,
kind of gives you an idea of what it would be. Oh, wow.
Check this out. I'm going to change the color to make it more visible. Maybe blue. Okay, here, blue. Check this out. It's not, here is the gold and silver miners.
Yeah.
Here, the gold and silver miners. Here is the unemployment rate. So here you see the unemployment rate, higher lows, higher highs, and look what the miners do: higher lows, higher highs. It did that during the whole 70s. And look how they exploded a little bit before the unemployment rate went up. The gold and silver miners, they're like, maybe this is the closest like narrative I could find, is they sense out the recession, maybe the drop in price of energy costs, and then the future gains, and gold sniffing out the destruction purchasing power in the fiat. So gold's going up, but energy costs are probably going to go down. And these miners, they sense it. Look, the market's pricing the miners ahead of time, right?
Yeah.
Let's go back all the way here. Look at here. It tracked a lot. Here, same thing. Here, this time it was unemployment going up first. And look what the miners did. Bottom and just rocketed, right?
Yeah.
Here they went up again, heading into GFC. But this is the fear scenario everybody has. A GFC type of event, bring the miners down 40, 50%, right? Everybody's scared of that. But other than the GFC, let's say we have a recession. Here, it's seen the 2001 recession. The miners never gave anything back, right? They just
they had a little tiny blip there, and then they were off to the races.
Yeah, tiny blip. They were already super low. They were depressed, like for 20 years, have been going down.
Yeah.
So it all depends what type of scenario we have here. And here, look, as the unemployment rate is deflating, guess what happened to miners?
Yeah.
All that money is heading into the stocks, everything grows.
Nvidia.
Nvidia. Oh, yeah. Nvidia. Name your poison. But here on their own chart, the gold and silver miners, higher lows.
Yeah.
Even if the unemployment is going down. But look at that. Here's the COVID wake up.
Yeah.
COVID, what happens? Miners go bonkers, outperform everything. Again, recessions, they sniff that out. And look what they're doing today. Look at that.
Yeah.
Look at that. They're tracking. Look at that here, how they're tracking unemployment rate. So guys, put that around your head. The miners track the trend of unemployment rate. Try to figure that one out. It's like, you don't need to after that. And that's like economics, nobody's, well, okay, I guess maybe some people could say that the unemployment rate is manipulated, but there's a whole bunch of other rate of indicators. You could initial claims, maybe the non-farm payrolls. But what's this telling me? Whether the data is manipulated or not, doesn't matter. This is telling me, the miners are telling me there's a problem in the economy. Yeah. They're telling me energy costs are maybe going to go down. They're going to be an issue. Gold's going up. This is not good for the economy. The miners going up. It's not good, guys. It's just not good there. So there's look at that.
It's very good if you're a gold investor.
Yeah, exactly. Yes, of course. And yeah, the miners have been, I think I saw Jeff Clark post this, like since the beginning of the year, JDX is like probably the best performing asset in the major asset classes. It's up 50% or something since the beginning of the year. But we've had a clean breakout here in the ASA chart right there. One touch, two touch, three touch breakout. Now it's getting stretched. I could just show you guys before we go into individual charts there, move indicators.
Okay, so this is ASA on a candle chart.
Yeah, candle chart, monthly candles, guys. So if you want to reduce noise, you have a beautiful, beautiful breakout. One touch, two touch, three touch, bam. Golden cross, 12-month, now trending nicely above the 12-month moving average, above the 3-year moving average. But this is my only beef right now. Is this, the bottom pane, Steve, is the distance of the price from that red line, the 3-year moving average or the 36-month moving average.
Okay.
And when you're stretched, that's when FOMO gets in. That's when people start going, I want to buy, I want to buy. Your uncle, your neighbor, everybody in the family wants to buy gold and silver miners. But look at this. Look, statistically, most of the time, I just drew this line here. I'll make it thicker, here, bigger. If you look at this objectively, how many times have we been able, the price of the gold and silver miners, have they been able to distance themselves more than 79% above the 36-month moving average on a close basis? One time here, 3, 4. 2, 3, and all this region here. But the 90% of its time, it's going to be in the bulk, right? The bulk is below that, right?
Yeah.
So it doesn't mean the bull runs over by any means. It means that low risk entries, they are found. Look, I'll put this thing here. I'm going to make it thicker. Here, at the peak here, at the peak here. I'll put the peak here. The low risk entries are found when you're coiled in tight, close to the moving average, and starting to break out. See that here above the golden cross. When you're coiled in tight, you're low, or you're starting to move up. Nobody wants the miners here. They're terrible. But look, they're starting to trend upwards, like above their 3-year moving average. That's the low risk entries. What it means is when you're stretched, doesn't mean Cameco will go up, but you're more vulnerable for corrections, for sideways moves until the moving average resets. See here, practically went sideways since 2002 all the way to 2005.
Yeah.
But guess what happened when it went sideways? That red line, put your eyes on the red line, it moved up and it created a reset. And then once you get a new breakout here, that's the next low risk entry. And then bam. See, that's when you have the second run up, right?
Yeah.
Here we are again. See, we FOMO. It was crazy 2020. Remember that silver squeeze? That was crazy times. Price went sideways. It could have went up, but it couldn't. It was discovering this resistance. And so instead of going up, it vomited. And that practically triggered everybody out, unless you're like your hardcore stacker or long-term holder. It's very hard to hold through this type of correction. This is crazy. It's a correction in price and in time. That's like, it's a double whammy. Like you need what diamond hands they call the people who go through that. It's like, or divorce. Like if you could survive a divorce, because your wife's gonna probably get mad at you for a while. So it didn't have to do that. Here it reset it back into 205 and it rocketed upwards. Here it didn't do that. So that's the risk when you're buying up here. Yes, it could do a bullish consolidation that doesn't hurt too much your emotional capital, but sometimes it just fails and then you're stuck. So the low risk entry, and this probably killed everybody's morale down here. But then after that, as it started climbing up, guess where the low risk entries are? Again, they're somewhere around here when you're starting to trend upwards. But look now, we're all the way up here, Steve. It's not I don't want to hurt people's expectations, but when I see that, it's telling me that I'm not saying the trend is over, but I'm saying that a correction is, if we lose a rising support, if ever we lose a rising trend line here, you could expect some type of, a correction here. You want it to reset to explode higher, right? If we're lucky, we're going to get something like this there, where it's, even that wasn't super pretty there. The price went sideways. It's, it could be the end of the run here, actually, or very close to the end of the run right now for the miners. I could zoom in on the smaller time frames to give people more. Let's remove drawings.
Let's look at the weekly and the day.
Yeah, that could help a lot of people. So here is the weekly. Oh, goodness. Okay. We're still above that rising trend line. That's an expanding wedge. So the momentum here, the distance from the 36-week moving average. Let me see if it's breaking down here. It's okay. It's still okay right now. But if ever it loses the 12-week moving average, I wouldn't want to see it close below here there. And that is the $31. If it closes here on the weekly, then you could imagine some type of bullish flag, maybe that's going to morph into existence, something like that. And then after that, it lets the 36-week moving average catch up, and then it rockets upwards here. So it's stretched. You could also do measured moves, classical TA measured moves, and see if those targets are reached. And from what I see here, often it's like this. You have a move, and then after that, a pull flag move, pull, flag, and then the move. And look, the targets reach also there.
Yeah.
So you have a classical TA measure move. So while the price is still in an uptrend, great. If you're a stage analysis guy and you like uptrends, and you don't, just forget what I'm telling you about, like, you know, all the classical TA stuff. But from a classical TA perspective, the energy that was here that created this move up, and this consolidation here that created this move up, they've used their fuel. It's very rare you'll have, oh, here it kind of did it. Here's a measure move. It's very rare that you'll get a measure move that goes, well, yeah, here it actually undershot here. Yeah, the COVID kind of broke this. Maybe this is the bigger move. And then you got a measure move that went up here. It's very rare that you'll get a classical TA measure move that really, really extends way, way above here. Look, I'll go back to 2006. The base, the breakout, the move, the first move, and then after that, maybe here a pull flag. And sometimes, yeah, this one actually the GFC interrupted it. It didn't quite make it. So it's very rare you extend. That's every single time people say, it's going to be different this time. But often, it's more often than not there, the price is probably here going to range. Whether it goes up a little higher and this thing goes sideways here, or it's close to the end of the road right now.
Yeah.
It did. Yeah, look, it did a great move there. Goodness, off the bottom there. Anybody who bought there on the monthly chart.
Yeah, like gold miners have had a really nice run.
Oh, goodness.
We got a bunch of questions on gold itself. Can you pull up the gold chart?
Yes.
Got one from Dak, Happy Dolphin.
Same thing as the miners. So in regards to classical TA, here you have a beautiful multi-year base, rocket move upwards. That's my move.
Yeah.
Then after that, I have my consolidation here, and then add on top. It even overshot. So gold's one of it actually overshot here, and we're super stretched from the moving average. So look at that historically. Same thing as the miners. It's yes, if we have a 70s type of move, it's possible, but it's outlier territory. It's just, look at that. We're doing stuff that rarely has happened before. So you could have, the low risk entries just aren't there. So if somebody's on the sideline and says, should I go into gold right now? My answer is no. If you're in already and you bought here in 2023, as soon as you did that classical measure move, you could have exited. But that's if you're classical TA guy. But if after that, if you're a trend follower, then somebody asks you, Patrick, should I still be in this? And based on the trend following system, I said, yeah, sure, you still hold. You still hold because you haven't closed below that 12-month moving average, right? There's no reason to sell until you close below, right? It just happens that sometimes, if by the time it closes back below that 12-month moving average, it might be exactly the same price or close to the price that you would have exited if you would have sold into strength here, when it felt really weird and wrong to sell into strength, right? Because it's hard to sell into strength when the gold was at this price.
But you end up giving back what you had 12 months before.
Yes. So the only negative on that is opportunity cost, right? Or it's a price to pay. Either you sell in strength, but you don't know if that was the ultimate strength because it could keep going up based on the trend, or you wait until there's weakness, but the weakness might be close to that area if ever it goes all the way down here. It's there's no system that's perfect. You can marry both of them. You could some people decide to take half off once they get a classical TA measure move, and they say, hey, the trend's still up. I'm going to ride it, man. I'm riding it. And then you sleep like a baby at night because you've already locked in a bulk of the gains. And then what you do, you wait for this to happen. I'm going to put my little, you wait for this to happen. And then you buy you buy down here or wherever that line, a new line will morph into existence, Steve. They always do there. They'll get a line here, just like you had here in the deflation here, could have bought here. And then for those a little bit late, they could have bought on the horizontal breakout. But essentially you'll get that. And those are the lowest entries. And it will be hard to buy there because the news will be bearish. There'll be a 2-year consolidation. People say that, it's the history of the psychology of this repeats over and over. It's very hard to buy when this thing's at the bottom starting to move up. And it's very hard to sell when you're on top there. It's just, it's because you know how it is. You go on Twitter or X or social media and everybody's super happy because everybody's super rich here. They made a bunch of money when it gets here, right?
Yeah.
And if you're on the sidelines, you want to make that same amount of money that guy made, right? But you need to wait. It's sad to say, but if you hear somebody about making a bunch of money, the best thing is knowing that probably you're far from the entry point, and you need to wait for everything to reset once again.
Yes, yeah. I kind of look at it like the objective is to make money. You don't have to make money in gold stocks. You could make them in copper stocks. You could make them in oil. You could make them in fill in the blank. It doesn't matter. You don't have to be married to this one commodity. Wait for it to cool off and find another bet.
You want to look at copper? Great point. Because look at copper. Take all the lessons I mentioned to you, right? Everything. Mm-hmm. Look what's happening to copper.
Boom.
It's time. So now, while gold is stretched and people are chasing that, look at copper. The momentum, that's a distance. It's not stretched anymore, copper. Look at that. It's totally reset, right? Went sideways, a beautiful consolidation because it didn't consolidate too hard in price. It consolidated in time and price. Look, they're both moving averages are coiled and tight, 12-month, 36-month. These are very, very rare opportunities. And then you have a move here there. It's happening. This is the copper miners. And had a false breakdown, reverse move up, super bullish. If that thing continues upwards, false breakdowns that reverse upwards, Steve, it's almost more bullish than just a breakout because it traps so many people here that they were expecting it to go down. As it goes up, they have to fuel the move up, right? Because they have to cover their shorts, and it's a double whammy. And look at that wick here, guys. It went copper. The copper miners are all the way down here. That's crazy.
I was lucky enough to catch that bottom part of the wick.
I was bearish here. I was telling people it's crazy, guys. It's like you gotta. I always wait for a little bit more evidence. I'll be always late before the breakout, but I don't care because I'm gonna catch my goal. Everything I do is built on catching this move. This arrow, guys. That's what I catch. Yeah. I never catch this. Never, ever. Because these moves down here. Look how many moves down there were here. Everybody thought they were a hero here, right? Yeah. I'm buying it here. I'm a hero. Oh, no, I'm a hero here. No, oh, eventually you'll be right. It's fine, right? Sometimes, but my system's programmed that I can't do that. I will catch these moves, but look, even if there's a recession, guys, sometimes copper, I'll show you Freeport McMurray, FCX, because we have more data. And I'll overlay the recession chart. Recession indicator. Yeah, if there's a recession, Freeport got hit hard, but you see during the 1, 2, 3, 4, 5 months during the recession, it went up here. Even here in the 2001 recession, it went up half, and then it gets, when there's a liquidity event, it gets pulled down. So you can't live in fear of recession. There could be one, but right now, if Freeport's breaking out, you got to play it there. You play it, and then if it fails, there's still it's still early for the copper miners. They are so not stretched, Steve.
Yeah.
It's still somebody could actually wait. Let me put the quarterly chart. Yeah, it still hasn't broken down the quarterly chart. You could still wait. And if ever you get a quarterly close above that, oh man, what a higher lows. And after that, if you get a close here, it's gonna be a higher high. Oh man, that's one heck of a correction, consolidation to be able to play there. Yeah. So yeah, there's the copper miners. So you could make money there, guys, eventually.
Yeah. I like copper over the next few years. I think it'll do really well.
Yeah.
How about silver? We got, let's see, Hans is asking about what do you see in the silver chart?
Well, Okay, so long term, here's the yearly chart, removing the drawings. It's at the end of the year, if it closes above 28, 30, if it closes above, like if it gets a yearly close here, that's a historical 45-year breakout. 1, 2, 3, and break. That's crazy. That's just, you'll never see that in your lifetime ever. You'll see it once in your lifetime, and we're here. So that's if you buy a yearly breakout, that means there will be crazy drawdowns along the way. Here, look in the 2000s, right? Silver went all the way up here to $21, and it went all the way down here to, move that, all the way down to $8 in that same year. But it kept going up and up. So when you get these breakouts, the move is going to be sustained. It should be sustained for years and years and years. So for a stacker or somebody, stackers don't care about price, but if you're a stacker / investor where you don't really want to buy, even if you love silver, you don't really want to buy these peaks. But this is telling you that higher lows, higher highs, it's an uptrend. So that's beautiful on the long-term chart. And it's not stretched. It's just starting to take off. There's still some room before it gets tired. The semestrial close, we just had a semestrial close a few days ago or last week there.
Yeah.
And look at that, silver's highest semestrial close ever. But contrary to the semestrial close, it had higher ever. Because remember here in 2010, it had its highest semestrial close since 1980. But it was starting to get stretched here. It was starting to get high here. But now we're having the highest semestrial close ever without the price being stretched from its 36 semestrial moving average. So moving averages are coiled and tight. They're not stretched yet, right? When I mean stretch, guys, I'm not just inventing that. It's based on previously how high it could go. Even down here, if it hits like, look at that. That's fuel there for silver to run.
A long way to go. Yeah, the way I look at these, tell me if this tracks or not, Patrick, is basically they're kind of like little soap bubbles of support. And the closer it is to that distance from the simple moving average, the more it's support and the closer that support is. As it gets stretched and further away, you kind of pull the rubber band and it's further away from that soap bubble or that trampoline or whatever of support. Does that make sense? Or?
Yeah, exactly that. And there's nothing holding you. Because for the moving average to be coiled and tight, that means a lot of price action happened close to that, right? People previously who ran up the price, they took profits, they got out. And then you have a whole bunch of new buyers coming in here. Like they just bought, or long-term holders, investors, pension funds, whoever's buying, they're buying a lot here. And once it starts price moving up, even if the price starts going back down a little bit, they're not going to sell them. They're going to have targets. They have price targets in mind. They're going to wait, and they're going to wait until they've made whatever percentage gains they want to make on this thing. And then they start selling. So that's when you're starting to get stretched. And once these people start selling, then it plateaus the price. And then you're vulnerable because most of the people, they did not buy on the way up. Most of the people, they bought at the bases, most of them, right? They bought at the base. So here it's very vulnerable on the way up. And then that's why I look at the corrections here. When you go up crazy like that there, then after that, you get these 60% corrections and bam, that go down. Yeah. But you don't get these 60% corrections off basis. Once you have a crazy base breakout like that there, you don't get a 60% correction until it's really gets stretched. Yeah. So that's silver. So it's looking good long-term. I don't know if you wanted to know short-term there, but yeah, short-term, it's consolidating. It's not stretched. It's reset here. That's the distance from the 36-day moving average. It's starting to want to turn back up. So we have to see where, it's kind of a little congestion area box here, expanding wedge.
But it's kind of like a bull flag there, or is it more like a kind of an opening wedge pattern?
Yeah,
what do you see?
It's flag. I call that all this sideways move, no matter what the pattern is, whether it's a expanding wedge, the descending wedge, whatever the pattern is, what it's telling you, it's a sideways move, letting that longer term, or here's a 36-day moving average, catch up. And that's the trampoline you need to recreate a base, to relaunch that thing. And then after that, once you close above that, then after that, it just relaunches there, right?
Yeah. Okay.
But it's dangerous buying in the zone, because all important market tops, always start with shorter term bullish looking corrections that fell. But yeah, this thing until it fully breaks out there, this thing could fail. But if it fails, then you need a lot of damage here, because to really destroy the longer term uptrend, like I showed you here on the quarterly, is going to take a lot of damage there before that longer term uptrend gets destroyed there. You're going to need a lot of damage. But it's all about a failed trade, Steve. A trade that fails is somebody who entered the trade on a time frame with a specific framework, but he did not respect it. So you know how people sometimes they come in to make a quick buck, they go on the daily chart, oh, it's breaking out from that bull flag, I'll make a bunch of money. But then after that, they don't exit when the bullish looking bull flag doesn't break out, it breaks down. I'll stick around. Then instead of being a day trader or a shorter term trader, they become an investor now.
Yeah.
Right. And that hurts, because when you look in the mirror at the end of the day, it hurts your emotional capital, because then you're like, you lie to yourself, right? You should have just exited, or you're too lazy. Some people that have 20-30 miners in their portfolio, and if that happens across the board, it's too many fees, or it's tax loss season, I don't want to, whatever it is, they don't want to go and click sell, and then they're trapped. So for me, that's a failed trade. Sometimes you get breakouts, Steve, and they reverse, they go down. If you exit as per the design of your trading framework, it's not a fail. It's a success if you respect your trading framework. What's a fail is if you don't respect your trading framework, then you burn your emotional capital, then you're 50% drawdown. Then instead of needing 5% to break even, or 10% break even, if you go down 50%, you need 100% to break even. Then you start gambling. You're on tilt. I don't know if you ever played poker. Yeah, double or nothing. Then you're just gambling there. It's crazy, right?
Yep.
So just guys, respect your framework. That's fine. If you're a long-term investor, don't even look at the daily chart. Look at that quarterly chart, that yearly chart, and don't go on Twitter. Don't look at the chart. Like just look at the chart once per year, and you're good.
Yes.
That's my rant, guys.
Have tight stop losses is what I hear you saying.
Well, whatever your stop is, respect it. So some people, they love putting a stop below a swing low. You can't play the daily chart and then have a sell stop based on the quarterly chart. It's weird. If you're playing the daily chart, your entries based on the daily chart, your sell stop should be defined on the swing low on the daily chart. You could put a sell stop super far away, but that means you're not playing the daily chart anymore. You're playing that higher time frames, and so just keep looking at that higher time frame and you're fine.
Yeah. Okay. Can we move on to, we've got Mike and Chris are asking about lithium. What do you think about lithium right now? Is the bottom in? Also, how do you think it'll perform in an economic downturn?
Well, here's the ETF though for the lithium ETF, guys. It's just terrible there. It's been terrible for a while, but I haven't looked at it in a while. There is some signs. It's starting to slow down. So its downward trajectory is starting to slow down a little bit via these less and less slanted, but they're still very slanted there, guys. This is I'm probably going to it's going to be hard to get interested in lithium there. We're probably going to have to do some type of base here. It's probably going to look like this, guys. Where's my path? There you go. Let's say it does go up here, and often it's going to go retouch that declining 36-month moving average, and then you're going to get a reaction here, and then maybe a breakout. But that's like you could be in mid 2026 here before that happens. And unfortunately, I don't have a lot of data. And there's not much data, but that thing's still in the downtrend. So you can see lithium as a possible upcoming commodity play, but the chart's not ready yet. You're too early if you're here. Here's the weekly chart. Maybe on the weekly chart we have something. Even on the weekly chart, guys, it's not breaking out here. There's a clear breakout line. It's all the way up here. Is it waking up here? There's still some work to do there.
Okay.
There's still some work to do, but there will be. This would probably be a reverse symmetry move. There's probably a nice play coming up, but Compare that to copper, which copper is like much more ready, right?
Yeah, yeah. Copper's already broken above, and this one still has some work to do. I was talking with Rick Rule about this one a bit ago, and he says he might be interested in lithium in 2026 or 2027.
Well, I don't know if he's looking at charts, but look, this is where it could break out there, like
Yeah.
later, yeah, early 2026, late, like you gotta, you don't want to be stuck in here, buy lithium, and then you see all the other commodities that are ready, that are moving up, and it's just gonna hurt you. It's gonna break your heart. Oh man, uranium's going crazy, but I had a fundamental thesis about lithium. It looked cheap, yeah, but it could stay cheap.
Yeah,
You
yeah.
don't know how long the market's gonna hold this thing back until it goes up. It's like just look at the charts, guys. You'll get the timing right.
Yes. Okay, we got some individual stocks here that people have asked about. Can you pull up PDN? I think that's Paladin.
Yeah, uranium. Yeah, so Paladin did great, but it's not one, like if you're gonna play uranium, there's one word, three initials. I'm going to tell you guys: CCJ. That's the horse you want to play there always. So Paladin broke out, retest, but look, it's still below its highs here. The momentum, here's my monthly chart, still hasn't broken out yet. Yeah, so while you're, yes, if I zoom in here, yes, here it's starting to move up again. But you know how you want to know which one to take? Let's say I do PDN and then I divide it by Cameco. Using a ratio chart, I could tell you which one is outperforming the other. So if this chart's going up, this is Paladin outperforming Cameco. So Paladin did great Cameco did great in the 2000s. And look at that, Paladin did even better.
Did even better, yeah.
So in the 2000s, when you see a chart like that, and then after that, you're starting to, maybe there's a wall here. You hold Paladin here. But as soon as Paladin loses a 12-month, loses a 36-month moving average, and lost like a huge topping pattern here, which could have been a consolidation breakout, but it failed. Then you hold Cameco instead of holding Paladin. Here, Paladin had a nice little run versus Cameco. So here you could have held Cameco, Paladin instead of Cameco, made more money, while both were going up, both were doing great. But here, you had a breakdown here of this pattern. Cameco has been outperforming Paladin since 2024. And look at that. You're still, so while you're looking at the Paladin chart, Cameco is like just, look at Cameco.
Just
Instead of
killing
it's above, it's, it's like you should be in Cameco, or even URA there's doing, even URA is doing better than Paladin, right?
Yeah.
It's kind of, I know nothing about these company fundamentals. I know nothing of that, but it's the aggregate of everybody, right? Because this is the thing. Let's say I bought Paladin. I read one article a while back on Paladin. I bought it. The price went up. Cool. Confirm my bias, or I think that it's the article that I read. That's why it's going up. But then I'm going to live in an echo chamber with that piece of bullish element, or I'm going to just seek out just bullish YouTube channels that talk about Paladin in a positive way. But I'm going to be closed-minded to all the other narratives that why the price of Paladin might not be going in. There might be insider selling. There could be a whole bunch of stuff. And sometimes the company is just great and the market just frowns upon it for X reason. Well, you might know 10 years later, but do you want to wait 10 years and find out why you're losing money? You bail. Look at that. URA broke out there. Goodness gracious. URA broke out there last month of a rising trend line. I'm not super a fan of this. But essentially that could have been bearish. It had a false breakdown. So it broke down. That wasn't false. But it's a false breakdown in hindsight because now the price went back up. So right now you're above both moving averages. It's an uptrend. Huge volume defined base. Let's see how high this little volcano could ride there. But
yeah,
those are a little bit better horses to ride there.
That hit Goldman's question as well. So you like Cameco a lot more than Paladin right now. How about a silver miner, Vizsla Silver, VZLA?
My goodness. Vizsla. The Canadian version or the American version?
He doesn't say. Let's go. I think there's more volume on the TSX.
Yeah, let's do that. So Vizsla, look at this thing. What do we have here? Breakout, retest. It's in an uptrend now. Unfortunately, I don't have a lot of data, but it is above a 12-month moving average. It did break out of a pull flag pattern, which has a target been reached. Pull flag. Yeah, target's reached. So the classical measure move of that pull flag pattern has been reached. It's in an uptrend. Is it stretched historically? It looks like it's stretched, but it's been stretched more before, and I don't have a lot of data. Sometimes I like going on the weekly. Oh man, took a little dump here. So you see why it didn't dump because it was stretched, but often you see how stretched it was here. A lot of people probably going crazy.
Yeah.
It just doesn't mean a correction has to start, but you're more likely. Anybody, guys, just please, before you buy a stock, if somebody hears you, go check the distance from the moving average. Here's on the weekly and see if you heard about it 2-3 weeks ago. I'm going to buy it. Well, the low risk entry was not there. The low risk entry was four weeks ago there when it was just starting to move up, right? Just starting to break out here. Yeah. It doesn't mean it can't go up, but I'll tell you what hurts, because if you do enter when you're stretched from the moving average, your mindset should not be to expect the next day that it goes up. You should actually expect it to start going down and start correcting, and that you'll be trapped for 1 week, 2 weeks, 3 weeks, 5 weeks, 2 months until this resets here, right? Just like I've showed you before, until this resets. This should be your expectation. So fine, if you really want to get into Vizsla or whatever stock, and it is stretched historically on its own price chart from its moving average, prepare your mental to expect a correction in price and or time. If you can't imagine that, and you can't suffer that, or you can't phantom the idea of this thing not rocketing to the moon, it will destroy you emotionally. And if your emotions are gone, then you'll sell exactly at the bottom, exactly when it bounces on something. That's what you're going to sell every single time. We've all been through that. I'm saying it like that. I don't know if it's hyperbole or whatever the word in English, but we've all been there.
Yeah.
Right? We've all been there. You didn't look at the higher time frame. There's beautiful support, but because you're down 30%, it just breaks your heart and you sell. And then when you know what you do, you go buy the next asset that one's stretched from the moving average because people are talking about it, went up, and then you jump ship at the wrong time, and then you rinse and repeat. You're in a vicious cycle. Don't do that, guys.
Yes.
It's hard. It's hard. We're laughing here, but we've all been through that pain of buying in the FOMO.
Yeah, before I understood how to look at a stock chart, that was me all day long. I was reading a newspaper to try to figure out what to buy. Okay, let's. Shane has a question. EXN on the venture. I think that is Endeavor. EXN? No. EXN.
Excellon.
Oh, maybe Excellon. Yeah.
Excellon Resources. Oh,
I'm not familiar with this one.
That thing started to wake up. So on the monthly chart, that chart's a disaster. It's starting to move up here. So here, I'm looking at it. Okay, I have to zoom in on the weekly to get some granularity. So on the weekly chart, oh man, that's a penny. That's what's the market cap? Oh, 53 million, guys.
Oh, there we go. That's why.
That's why, guys, man. Is this a penny stock scam? You gotta be careful with this stuff, man. But but you know what? In bull markets, if the ASA chart's going up, the capital flows are going into that, and they go everywhere. The money's coming in. Gold and silver miners, even these crappy miners that are frauds, they'll go up there because the chart pattern mimics the one of the index to a high extent there. Like I could overlay. People always think that, there's something special. No, there's not. There's just money coming into the sector, right?
Yeah.
So it is a super stretch now from the 36-week moving average. So right now, FOMO time, 100% FOMO time. And yeah, it's stretched. So you got to expect a correction there. That's going to start happening. Yeah.
Yeah.
Measured moves here. Look,
Volume has died down.
well,
Looks
that's
like.
okay. So
Okay.
here you had the breakout volume.
Uh-huh.
So the volume is resetting. That's a good sign. But often peak volume, you see peak volume at important bottoms, but you also see peak volume at the tops here. So the reset volume, it's okay. It'll create eventually the next launch pad, but the next launch pad, again, I'll draw these guys. Go draw the lines, because once you see the lines, you could see the next low risk entry, if ever there's one. It's going to be later this year.
Yeah.
There's
Yeah.
no, but it's an uptrend, guys. It's fine uptrend, but you got to expect some type of correction here, sideways move. The classical measure move is reached, and yeah, here it reached a wall here. Previous support turned resistance. It tagged it. That could be it, guys.
Okay. Let's. Justin's asking about GSVR. Which one? G. G is in golf.
Ah, yes, Guanta. I can't pronounce
Guanajuato.
Yeah, thank you. Okay, so yeah, so let's look at the monthly chart. So yeah, that one did. It's still consolidating. So what I love about these long consolidations, guys, is you get some clear breakout lines. Look at the distance from moving average, fully reset, fully reset. So whatever signal it gives me here eventually, I don't know where it's going to be. I'm going to like it. And it's the big move for this this company here. It's probably going to be here. It's going to be when that breaks out. That's a crazy expanding, bullish, descending wedge. A lot of words there, but essentially these are bullish patterns, but they're bearish at the same time because the price is going down to create these bullish patterns. So the entry, guys, for this stock is here. It's once I close here above it, here, there's an escape route. If ever it could get there, the measured move will be, I'm a millionaire, mom, millionaire. It's going to be a crazy move all the way to $2. Yeah, 230, 240. That'd be the target there.
I notice you're using log chart. Do you always use log?
Always go log or go home, buddy. I'll tell you why. I picked on this guy there on Twitter. I didn't want to pick on him, but he's notorious for just using linear chart.
Uh-huh.
I'm not gonna. You guys could go check it out there. Have fun there. And this is the issue I have with. Okay, I'll show you. This is a great question. I have to show people why. Because there's only one time you only use linear if there's a negative number or it's you're in an oscillator. But other than that, you should never. There's no reason to use linear, because think about it this way: linear. If you put the linear scale and the price moved in the linear fashion, it's fine. But if you put a log scale and the price moved in the linear fashion, it will look just like the linear chart, because the price scale will look practically the same. But log permits you, if the price starts moving in a logarithmic fashion, the log chart will automatically adapt to that exponential move in price, right? And it happens practically on all charts over time because of the destruction of the fiat purchasing power. Charts, they don't oscillate sideways. They're skewed upwards because the destruction of purchasing power is skewed downwards. It's just
as they print more currency units, it takes more of them to buy whatever stock. Yeah,
everything's built going upwards, or else stuff would probably go sideways a little bit, much less acute. So here is my super duper chart. It's crazy because right here it is. So here's SPX, guys, on the log scale since 1871, and look at this beautiful rising trend line, and then the bounces here. Nice bounces, and here even there's a rising trend line on the log scale. So here my support, I did this chart a while back, but the support was at 5.4K. But if I try to do a support line on the linear scale and price has started moving logarithmically, look at where my support is. It's all the way down to 3.5. For that same time. Like, you got to look at the log. If you don't look at the log, you're waiting for price to bounce on 3,500. It's going to bounce on 5.4 way before. Like, this is an equivalent rising trend line, right? So that 3.5 is useless. That linear defined line, and guys, log and linear, it's fine. Horizontal lines, no problem, because horizontal lines, it's just for slanted. People look at slanted angled lines, slope lines.
Yeah,
you're not giving yourself the truth. You're not giving yourself, and targets don't make sense. And always log, guys, always.
Okay.
There's no reason to
Okay.
lose linear except, yeah, just use log and you'll be safe. You'll be more close to reality. Because what's reality? Reality is where's the actual support where the market participants are making the price bounce. That's
Yeah.
reality.
Yeah.
So look on the log scale. It's bouncing all over the place here. It has bounced recently. On the linear, it's not even touching that line anymore. That means the price has just accelerated to another stratosphere. It's useless, this line. This rising trend line here defined on the linear chart is useless right now.
Yeah. Yeah.
It's not as meaningful. I won't say useless, but it's not meaningful anymore. It's just
Yeah,
not
you can
there.
almost think of it like that red line is kind of the printing press. As
Yeah,
they're
yes.
printing more dollars, that's
Yeah.
kind of the fair value, right?
The delta, yeah, the delta, how far it's stretched. Yeah, it's destruction of purchasing power. We could adjust all charts for CPR inflation and try to tone them down a little bit. And then maybe the linear charts will not move as logarithmically as they do. But yeah, the price just so guys, just use please, yeah, just use log there. You're golden there.
Okay. Log. Okay, we got Guanajuato. And Munish is asking about the Nifty 50 chart.
50,
Oh, look at that.
Yeah, there you go. So that's the Indian. So this is priced in the Indian rupee. Yeah, look, that thing's been in an uptrend for a while here. So there's even on the log scale, it's starting to accelerate. So here's a rising trend line. Here was a rising trend line that broke down. So now it's starting to correct. You see the distance from the 36-month moving average going sideways. So the next crazy move for the Nifty, oh, look at that. 1, 2, 3. The next crazy move for the Nifty will be once it explodes. It doesn't mean it can't go up at this price, but once it explodes above here, you should have a re-acceleration. So if the distance from moving average, if that line's going up, that means I'm distancing myself from the 3-year moving average. So the 3-year moving average is already inclining and I'm able to go even faster. You always want to be in an asset that is able to outpace its moving average. Always, because that means the money's flowing in. It's like you never want to be in an asset where you're not able to outpace its moving average, right? It's like, yes, the price can still go up as the moving average catches up, but you're losing momentum. You're running uphill. You're running out of steam. So you want, stuff that explodes, right? So the Nifty 50 uptrend, fine. But right now it seems to be correcting. And for me, the next low risk entry is once we close above here on the distance from 36-month moving average. And if people are interested, we can, I can give them the code for this there eventually. I could put in the comments if they're interested in knowing how we do the distance from moving average thing there.
Yeah, that'd be great. Yeah.
Yeah, it should show up there, but it's not. All right.
Okay, yeah, if you want to get that to me, I can put it down in the show notes. Okay, and then Bach is asking about ASHR.
X Trackers Harvest, China?
That's it. So I guess this is a China ETF?
You're a traitor to the United States if you buy Chinese, guys. Traitors. Sorry, I don't want to get the channel banned or anything there. I thought that was funny.
So the other one was the Indian ETF, right? The Nifty 50. This one's the Chinese ETF.
Yes. So this is a harvest though. So I don't know, specialized, but it's not looking bad, guys. So valid rising, descending trend line breakout, 1, 2, 3. And that's just the wake up. The final breakout line is probably going to be above here somewhere.
Okay.
So it's it's not bad there. You look at that, guys. You might have a little bit of reaction here, and then you probably get some type of move all the way up here somewhere. And that's priced in USD.
Yeah.
But hasn't broken out yet. But higher lows. And then once you get a break above here, that means you have a higher high, and that is the definition of an upwards rising channel.
Okay. All right. And Beacon wants to know REMX.
Oh yeah, this is the rare earths. Well, you see, it looks like the lithium chart a little bit, right?
Yeah.
Maybe so no bueno yet. I know everything, a lot of money coming in commodities, but it hasn't proven itself yet. Here I could put in a line chart So that's probably my go-to. I could look on the weekly to see, yeah, even on the weekly, guys, we're still not quite there yet. So I'll put a horizontal line. Look at that. Here was the breakout line, resistance breakout here above the 12-week and the 36-week. And this could be exactly the same place again. Here's a shorter term pattern. It's starting to move up, but I would get way more comfortable if it could clear the cloud, or at the very least clear that 43.88 level.
Yeah.
And here's the beauty. Price went downwards. And here, look at this thing. What a beautiful, beautiful, look at this, man.
Yeah.
We're so lucky. You see patterns like that, and you're on the sidelines, and you did not have to go through this hell of going sideways. And you could just be the guy who just gets lucky, goes at the bar, meets the perfect girl at the right time, and leave home with her without having to spend a whole bunch of money.
That's a great analogy.
Yeah, well, timing, right? You don't have to go there at 10 a.m. and you're drunk, 10 p.m. and you're the first one drunk. And then once you're starting to slur your words, bring any type of
then you have no chance. Show up for last call and take home the prize.
Oh my goodness. What's up with us today? My goodness.
All right. Let's see. LN Research. He's asking about a currency question. So he's, hey guys, can you review the euro divided by the Canadian X-rate chart? It's rarely on the radar in a current setup of Canada being comparatively high to USD. Euro might be comparatively high to the USD. How does that look?
Euro. So he wants what the euro CAD. So the euro broke out versus the CAD right there.
Yeah.
1, 2, 3, breakout. And it is getting stretched. So what you could see now is even the CAD, guys, the CAD is starting to mount the comeback against I could show you that one. So the CAD's starting to show strength versus the USD. The euro has been showing strength versus USD way before the CAD. So the euro is stronger than the CAD as per this breakout and uptrend.
Mm-hmm.
But because we're stretched here from the moving average, what you could expect, once again, this is not a low risk entry to go long euro instead of CAD. This is actually maybe an opportunity for the CAD to catch up here. You might have a correction here and let that moving average catch up, right? Again, you see this stuff? It's like it repeats over and over. So uptrend, but possibly a correction going to happen for the euro versus the CAD. I'll show you. I'll jump to the USD CAD to add
I was just going to ask you that.
To complete the threesome. So here's the euro, the USD, and look at that. The US dollar has broken down versus via the CAD. And this looks also like the gold silver ratio. This is stuff you see when commodities start doing well. And look, it's just going down, down, down. And it's, again, even the momentum here, it's breaking down on the distance from a 36-month moving average. So this is kind of meaningful, and it's not stretched in favor of the CAD yet, right? You could expect the bottom much lower there. I don't know. We're not there yet there, but it's lost the 12-month moving average. It's lost the 36-month moving average. It's and it's done a breakout.
Yeah.
And moved up and now failed, and it's going down. So that's a big no-no.
It looks like the Canadian dollar is going to outperform the USD for the short term.
Yes. Okay. Yeah, but this is a monthly chart, so short term could be 6 months or like many months. Who knows how long this? The next support level is, maybe here at 131 there. It looks like it's heading towards this region here. High volume node. Guys, this on the side is the volume transactions. Well, most of the price action was around 132, 131. Mm-hmm. So this is probably the next cushion area to expect a bounce in favor of USD. If ever USD was going to do a bounce here, it's going to be at that level there, 132 maybe.
Okay. What do you see in the DXY?
Well, the DXY is practically the Euro USD pair.
Mm-hmm.
The DXY looks same thing there. It's falling apart.
Yeah.
I was bullish at USD when it broke out here, but after that, it just failed to move. And once you're back in the consolidation period formation, you wait, but you know that the odds are that the failed move upwards would create a downwards move. And I've been bearish since on the monthly charts. Yeah, since it broke down here, and it's still in a downtrend there.
Yeah. Okay.
So it's no bueno for the USD. I have a feeling there. The USD is not a feeling, but the USD is about to. I could show you a chart, guys, that I did for the members. Do you mind if I show you guys this?
Yeah. See it.
Oh, this loads. Goodness. Let me show you this. I did it it's right here. This is the Canadian yields. Is the black line. The Canadian yields is the black line, and the golden is the US yields. And they're all synced on the same percentage scales. And you'll see since 1986 there, they've practically always trended together. And they've resynced on multiple occasions. They've resynced there where they touch together.
Yeah.
And look at that. Us, our unemployment rate is much higher than yours, Canada. We've been cutting our yield. We've been cutting because the Canadian bank tracks the moving average of the yields of the 2-year yields, and same for the States. The Fed fund rate tracks pretty much the 36-week moving average of the 2-year yields. And there's a huge gap here. Huge gap. Eventually, we'll resync. And pretty sure that it's going to resync. Either we go sideways here and you guys are going to go down. And why is this important for currencies? I'll show you why. Because the delta, this is the yellow line, the golden line is the US 2-year yields minus the Canadian 2-year yields. So if I ask you, what would you rather invest in, Steve? Something that gives you 5% or something that gives you 3%? What would you choose?
5.
All other things being equal.
5.
Yeah, the 5, right? So, and look how the currency pair, and the black line is a currency pair, not perfectly. That means there's other macro drivers I'm not aware of, but you'll see that the delta in the yields is carving out the USD CAD chart, and you could do that. I did this exercise for the euro, USD, all that, and it's pretty much the rates have a huge impact on the currency pair, huge impact. So it's not the tariffs, it's not all that stuff. It's the yield. So if that alligator thing, and here's if that alligator thing's going to go down, that's probably, and the USD starting to lose versus the CAD, it's already losing versus the euro, the DXY is going to go down. It's like the market's pricing in cuts, further DXY weakness via the less reasons to hold DXY US dollar instead of the other ones because cuts are coming.
Yeah.
Like today they're bouncing there, but this thing is higher lows, lower highs, hasn't done a lower low yet since that previous. So, but if you look at the other countries, it's very rare. You've never had, look here, I overlaid the recessions there, but I could have went back all the way to the 1970s. When you guys cough, we sneeze, but now it's us sneezing first. We've always had recessions together. We've always had these, when the yields melt down, they melt down. It's global stuff, guys.
Yeah.
So this delta here, it's almost like I don't want to say it's baked in, that it's guaranteed to go down, but there's a high likelihood that they'll have to cut the yields in the States in a crazy fashion there. I don't know when, but they're going to have to cut them there. It's going to go back to that first chart at the beginning of your show there when I showed you the unemployment rate, right?
Yeah.
And the miners going crazy up. Remember that miners chart tracking the unemployment rate?
Yeah.
It's telling you that the yields are coming down there. It's people don't want this. The yields are coming down. So that's going to bake in weakness for the US dollar. But then once the yields are down, then that's when people start getting bearish the US dollar, but it's probably going to start pricing in the opposite after that. You know what I mean? It's like, but this is for me, it's the pricing in of the yields there that it's coming.
Yeah. Interesting. Well, Patrick, thank you very much. If our viewers want to get a hold of you and follow your work, how can they do so?
BadCharts one, it's great, Steve. People gonna go have fun there, troll me. I enjoy it. And no, I don't. And I have a hard time understanding sarcasm, written sarcasm, maybe because I'm French, but sometimes people are sarcastic and I think they're trolling me, but they're just being fun. So sorry guys if I if I respond in a dry manner, But the best place, it's what I showed you there, NorthStarBadCharts.com, Steve. And maybe if you permit me there, I could maybe offer a discount code for your viewers if they want to get a 50% off there. Do you mind if I give that to your
No,
viewers?
not at all.
Or
That'd be great.
they could use NSBC Lifetime 50, and you could get 50% off forever there on our website. 7-day, no questions asked, money back guarantee if you want to get that. Because on Twitter, it's fun, guys, but I often do hyperbole, clickbait. I do a little bit of that. Sorry. But I don't answer everybody, but on the website, like we answer all the comments. We do chart requests. The whole thing we did today there, chart requests, we have a facility where we do that like regularly for members. Like they ask for these charts, even if they're penny stocks, we do stuff for them. So sorry about the sales pitch, but yeah, they could 100% get some value there, or stay on Twitter. It's all free, guys, and let's have fun there.
Okay, NorthStarBadCharts.com. We'll put a link down below. Patrick, thank you very much. This was a lot of fun.
Bye, guys.
And thank you for tuning in. Go to SteveBartonMoney.com for more, and have a wonderful day.